There is no such thing called is risk-free investment. Risk is there. And in that case, we have to choose which risk to take and how much to take. And when you have to make that choice, we got to understand the risks. There are 4 potential sources of this risk. And these sources of risk are 1. Volatility, credit risk, illiquidity, inflation. The prices of your investments keep going up and down. That's called volatility. The price fluctuation. Fluctuations mean sometimes you may buy at a higher price. And when you want to liquidate to fund your goal, the prices could be on a lower side, or you started with an assumption that you will get 12% return, and by the time you reach the goal, you might have received 15%, or you might have received 7%, or you might have received negative returns. Credit risk arises when you give money to somebody with a promise to get the money and some interest on it back, and that is not received in time. Illiquidity is that the money is very much there, but you can't sell the investment and convert it into cash easily. For example, real estate. It's not very easy to sell and liquidate the moment. I want to avoid these 3 risks I have to encounter with inflation. Money loses purchasing power because of prices of other items going up. If the inflation is 8% per annum, then every 30 years, the household budget multiplies by 10 times. The 3 primary risks are death, disease, and disability. The 4th is loss of job. Death, disease, and disability must be protected by buying insurance. Loss of job, accumulate an emergency or contingency fund. Multiple insurance products are available. When it comes to health insurance, you buy 2 separate types of insurance policies. One is called the health insurance, which is reimbursement for medical expenses, especially in case of hospitalization or treatment and stuff like that. The second type of health insurance is what we call the critical illness insurance. Certain really critical kind of problems, for example, renal failure, kidney failure, a stroke, a heart attack, and stuff like that. That's where critical illness insurance is available. Treat your life insurance policy exactly like your health insurance policy. You pay premium only when there is a death of the person, then the family receives money, or the nominee receives money. There is no money receivable at the time of maturity, because if you buy that kind of a policy, the premium would be lower, and a lower premium would allow the other part of the money to be invested in more liquid investments, which can be managed a little more actively. The risks have to be also seen in terms of these 3 primary objectives of any investment plan, where you want safety of principal and returns, you want higher returns, and you want liquidity. No instrument can offer everything together, and that is why you have to identify your unique requirements. And these unique requirements have to be in line with your unique situation and unique goals. The purpose of investment is to meet life's financial goals. And these financial goals are derived out of the events that happen in life. You got to define those in terms of when, the time, as well as the amount required. And once you define that, then they become financial goals, because now they are quantified, they are realistic, they are relevant to your life, they are time-bound, and they are specific in terms of the amount. Once that is done, you can work out based on the current situation, how do you invest so that at that point in time, sufficient money is available. The question is not save versus spend. The question is to spend now or to be able to spend in future. And if you evaluate it in that manner, you want to live a good life now, and you want to live a good life in future as well. And that's why it's not about which investment is better and which insurance policy is better or which loan is better. It's about what impact it will have on my life now and my life later.